Welcome to GRE. I'm your host, Keith Weinhold. Some concerning and alarming tax changes. Some are on the way and others are newly here. On a highly informative episode, I talked with two experts on these new tax laws. They explain them in a simple and understandable way and how they're going to affect you. Importantly, learn how you can legally and permanently avoid and reduce these new tax burdens today on Get Rich Education. Checkbook IRAs have been ruled illegal by the U.S. tax court. With contribution limits 10 times what traditional and Roth IRAs allow, get total control of all of your IRA funds without paying the nasty UBIT tax with the retirement plan answer left standing, the eQRP. You can invest your retirement funds in real estate, gold, Bitcoin, and even your own business. This works whether you're a solopreneur or have up to 50 employees. Learn more about getting started. Text eQRP in all caps to 72,000. The annual Spartan Summit is on. I was the kickoff speaker at the last event. This year they are back in person, and the keynote speaker is none other than Shark Tank's Damion John. Learn from industry experts on real estate, tax strategy, lending, and entrepreneurship. You'll also get to tour tangible turnkey income property in growing Alabama markets. It's coming February 16th to 18th in Birmingham, Alabama. Get your ticket or learn more at SpartanInvest.com today.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Canberra, Australia to Canmore, Alberta, and across 188 nations worldwide. You're listening to one of America's longest running and most listened to shows on real estate and investing. I'm Keith Weinhold. This is Get Rich Education, here in our 8th year of weekly wealth building shows. If you buy enough humble abodes for others, then you yourself can live in a not so humble abode. But do some of these new tax law changes threaten to stifle this? We'll see about that. And we're talking primarily about United States taxes today. It is that almost year-end time where it makes a lot of sense to discuss this in case you need to make some changes before it's too late. My two guests today are absolute experts. They're both advisors to me, essentially, and they basically follow along with this really boring stuff with the tax law and the tax courts, and then they bring these topics to life for an investor like me and like you, and then they inform us. Importantly, because they do understand the tax changes so well, they have strategies on how you can avoid the new tax, so they tell you what you can actually do about it. Our first guest is Tom Terrific. You probably know who that is by now. No, he's not Tom Brady. We're immediately going to transition then to our second great guest. And yeah, I turn to these people because they really are wealth building specialists. I learn from them, and I expect to do some learning right alongside you today because a lot of this stuff is so new. Looking down the road a bit on the show here in the next few weeks, one of our two guests today, it is Tom Wheelwright, not Tom Brady. He's going to tell us about cryptocurrency taxation. And, you know, I've already talked to Tom about this, and crypto is taxed in more places than I even thought. But the show in crypto taxation is 2 weeks down the road or more. Today, there are enough other alarming tax increases to discuss with Tom and Damion. Well, conventional wisdom tells you that the government wants to just tax. And a closer look at the tax law really shows you that there are numerous ways to reduce your taxes and benefit from doing what the government wants. And today's guest, really, he told me one of the most salient things ever about reducing your taxes. And that is the most recurrent guest in show history. Back here with us again, he is the Rich Dad Tax Advisor. Welcome back to Get Rich Education, Wealthability founder and CPA, Tom Wheelwright.
Always good to be with you, Keith. Great to be on your show and great to be with your listeners.
Tom, you bring energy to an otherwise fairly boring topic. And this salient point that you told me that I brought up, and it's the first time I had ever heard it in my life, is you're the one that let me know that the IRS is a tax code of about 5,800 pages. And it's really only about 30 or so of those pages that are devoted to raising one's taxes with things like those marginal income tax tables and so on. And the other 5,770 pages, the vast majority of this thing is devoted to reducing your taxes. So tell us about some more of your thoughts there and really how the tax code is more of a roadmap for finding the tax reductions and deductions.
Most people understand that income taxes are there to raise revenue for the government, but the government since the 1960s, really, President Kennedy, and this is true, by the way, not just in the US, but all over the world, has used the tax law as a way to incentivize certain behaviors. A simple example is you get a deduction for the interest expense on your house. If you're a renter, you don't get a deduction for your rent. So that's an incentive to own a house. And that's a tax incentive. And believe me, every mortgage broker, every realtor knows, they always talk about, well, look, this is a tax break for you. And that's a big selling point for buying a house. Well, that's just an incentive. We have other incentives. We have adoption credits. We have credits for sending kids to college. We have a new credit, really a new big credit, a child credit, which is really an incentive to have more babies when you think about it. I mean, it truly is. I have a buddy, he has 6 children. He says, yeah, the child tax credit, we call that the Christmas fund. And it's significant when you've got 6 kids with more than one under the age of 6. So these are types of incentives. Now, most of the incentives go to business owners and investors because what the government wants most are just a few things. They want jobs. And they want job creation. So that's why business gets a lot of tax benefits. Then on top of that, they want some other things. They want food to be produced, agriculture. They want energy to be produced, oil, gas, solar, wind. And they want housing. And those are the real estate tax benefits that we've talked about on your show before, Keith. Those are some of the things besides others like research and development, et cetera, et cetera. There are other incentives, but those are ones that I think people would all say, yeah, that makes sense. The government wants you to do that. Well, what the government does is they say, look, we'd like to encourage investors to put their money in those places that suits the government the most. After all, we know that people don't really like paying taxes. So when they first experimented with was an investment tax credit, they said, if we give a little investment tax credit for increasing your manufacturing equipment, will you buy more? Sure enough, it worked. That's what they've done over the years so that most of the law now is just incentives or directions on how to reduce your taxes otherwise, just because, you need rules to say so you don't take too much so that you get it right. But we always look at it, Wealthability, we look at it as a roadmap for reducing your taxes and, frankly, doing what the government wants you to do. So another way to look at it, Keith, is that you're a partner with the government, whether you like it or not.
Right.
You don't get to choose that. All right. And your choice is you can be a silent partner like most people and just earn your income and pay your tax. Or you can be an active partner and do what the government wants you to do, pay less tax, but put your money where the government wants you to put it and do those activities the government wants. So you get to choose. I don't think the government really cares which one you do, but know that if you choose to be an active partner, the government is all for that.
Expanding the child tax benefit might make sense in a nation with declining birth rates. Certainly, you talk about incentivizing what the government wants. We probably want more of a population to have a strong economy. But we talk more about what parts and what segments of society are taxed. Before we get into more of the specifics, Tom, just looking back philosophically, if taxes must exist, let's talk more about what it makes sense to tax and what it makes sense not to tax. For example, a lot of people champion a consumption tax. One might call that a use tax on something like gasoline. Those that use more gasoline to fill up their car with, that commute more, that are wearing out the roads, well, all right, well, that use tax is being built into that gasoline, that consumption tax. And that might be opposite of something where there's sort of this disjointed behavior with who's being taxed and the tax that's being given to that consumer. For example, I own rental property in multiple U.S. states, including including Texas. So some might say that's really not very commensurate with the taxation there, because I'm paying property tax, a big portion of which goes to school tax in Texas. And I don't live in Texas. I don't have kids in Texas. I don't have kids at all. So we talk about use tax or consumption tax. What makes sense?
You have renters in Texas and their kids go to school in Texas. So that would be the argument on that side of it. Is you're paying property tax basically on properties that you're renting, and the renters who are using those properties are actually sending their kids to school. It's like I pay property tax. I have commercial property. I don't have kids in school. I did. And, I pay property taxes on my home. Great. I'm going to send the neighbor's kids to school because my neighbors sent my kids to school. That's all fine. Commercially, though, I pay much bigger property tax on my commercial building, and there's nobody living in that one. However, my employees do send their kids to school. So there's some public good here and for taxing that. What's really interesting, you mentioned consumption tax, Keith, and the U.S. actually, our income tax really is virtually a consumption tax. If you consider that the only people who pay income tax are those who either consume their income or save their income. People who invest their income do not pay tax. I mean, even if you're putting into a retirement plan, you're paying much less tax in a retirement plan than you would if you use that money or put that money into a bank. The U.S. has pretty much gone to a consumption tax for its income tax. Most people don't talk about that. You never hear about that. But when you really break it down, investors, if you invest the money, you don't pay tax. If you don't invest the money, if you save the money or you consume the money, you do pay tax. So we are very much in a consumption tax age in the U.S. and the rest of the world.
You said something that does make some more sense on the property tax. One could say that, well, when I was a kid and I was in school, other people that paid property taxes basically paid to send me to school. And now I'm paying to send other children to school. I thinking through it that way makes it easier to, I guess, stomach. You bring up the income tax, probably the tax type that gets the most attention. Anyone that has a job has to face this. Do you think, Tom, that it makes sense to graduate the income tax like we do, where higher earners get charged at a marginally higher rate? Does that make more sense than having a flat income tax rate?
That's probably above my pay grade to say. The argument, of course, is that the more money you make, the less proportion of the money you're going to actually need to spend on basic living expenses. So in other words, if you go back to the origins of the U.S. income tax, it was only a tax on excess earnings. It was never intended to be a tax on basic earnings. That has been since 1944. In fact, it's been since probably the 1950s that we've actually had any income tax on base earnings. The idea was, we're not going to tax you on the money you need to live on. But when you earn more money than that, we are going to tax you. Well, the idea behind the progressive income tax is somebody who makes $500,000 uses a smaller proportion of that money for their basic necessities than somebody who makes $100,000. And so they have excess money to contribute to society through government taxes. That is actually the reason for the progressive income tax, is because you actually have more disposable income, if you will, once you get to a certain level. And the fact is, Keith, that once you make more than, say, $600,000-$700,000, you can't spend it all. It's very hard, unless you're going out buying a Gulfstream. It's pretty hard to spend more than $600,000 or $700,000 a year. The average person would never do that. So you look at somebody like Jeff Bezos or Elon Musk, who makes billions of dollars a year, they're spending very little of that money, even though they do have planes, et cetera. But you know what? Even those planes are probably paid for by the business. Those are business expenses. And they probably don't have a lot of personal expenses outside of their home mortgage. I know they've got, big homes and all that kind of stuff. The reality is that that's actually the argument for the progressive income tax, is that the more income you have, it's an ability to pay type of a situation. The less, whereas take, for example, a sales tax, or even worse, a property tax. Those are very regressive taxes. Property tax is the most regressive tax, meaning that the person with the least ability amount to pay pays the highest share of their income in tax in a property tax situation. When you consider that you have fixed income people, so a fixed income person living in a $200,000 house pays exactly the same amount of property tax as somebody who makes $400,000 a year in a $200,000 house. That would mean that the person with the availability for the money has the money to pay it, but they pay exactly the same. And that would be the argument against a flat tax. Really, the best argument for flat tax is it makes it easy. it means that it's a lower rate. I will tell you the downside to a flat tax and why it will never happen in this country. Because once you get below about a 30 to 40%, people stop changing their behavior based on taxes. And have you ever met a politician who was willing to give up power? Ever?
Not a one.
Not a one. And so the taxes, having taxes at that 40% rate gives them clout. It gives them the power to really incentivize certain investing, certain uses of that money, which they would not have if you had a, say, 15% flat tax.
You talk about how some people find it hard to spend $500,000 to $700,000 a year. I think most people out there are thinking, let me try. I would at least like to try to spend $500,000 to $700,000 a year. Tom, what is going on with our conversation here? With what we've discussed so far, we're making people feel better about paying property tax and about paying income tax. Usually that's not the way that the discussion goes here. I'm just having a little fun. But when we talk about the income tax and what's going on with it, if I remember correctly, it was the TCJA, the Trump Tax Cuts and Jobs Act, which lowered the highest marginal income tax rate bracket down to 37%. And a few months ago here in this new administration, I think that House Democrats, they unveiled a plan to bring that back up to 39.6%. So where are we at now congressionally and presidentially with the income tax? What's going to happen?
I actually call this the Costco Bill. And here's why. If you ever walk into a Costco, what's the very first thing you see? You see the very expensive high-end electronics and the expensive jewelry, so that by the time you get back to that $15 jar of mayonnaise, it seems like a bargain, right? That's exactly what's happened with this bill. It started as a $6 trillion bill. It went to a $3.5 trillion bill. It's going to end up somewhere around a $1.5 trillion bill, which makes you go, wow, I feel so good. It's actually decreased by 75%. It's
they anchored it high.
$1.5 trillion.
Yeah.
If they'd started with $1.5 trillion, they'd go, wow, that's a big bill. But instead, they start at 6, they come down to 1.5. Oh, this is good news, right? My buddy Andy Tanner says, price always has to be good news. Well, this is the situation where now price of this bill is good news. It's only $1.5 trillion. So here's what happened. And by the way, largely due to two senators, Joe Manchin of West Virginia and our own Kirsten Sinema here in Arizona, there are no tax increases. There's no rate increase from 37 to 39.6. There's no capital gains tax increase. And we still have our 1031 exchanges. What we do have in this new bill that is probably going to pass is we have a new 3.8% tax on business owners. And that was not there before. So we call it the net investment income tax in the real estate world. It applies, it's actually a pretty significant deal because if you're a real estate professional and you sell a piece of real estate, you didn't have to pay that 3.8% net investment income tax on that gain. Now you will. Now you're going to have to pay that 3.8%. So if you have $1 million gain, you're going to be paying another $38,000 in tax that you had not planned on. That is under the new bill, and that's going to pass almost for sure. It raises about $230 billion. So anybody, let's say, has an S corporation, and they have so it's a pass-through entity. They're going to pay 3.8% even if they don't distribute the income. That's actually the biggest tax increase in this bill. Another one, which, by the way, affects the real estate world, and I think this is huge, actually is already in place. All this bill does is extend it. And what it does is, under the CARES Act, I don't know if you remember, back in the 2017 Act, they put a limit on how much you could offset from business loss against other income. And they made it a $500,000 limit, only it didn't really apply to many people because they included wages in business income. So it could still offset wages. Well, in the CARES Act in 2020, they eliminated wages from the definition of business income beginning in 2021. So what that means is you've got two spouses. Let me give you a simple example. One's a real estate professional, and the other one makes $1 million as a medical doctor.
Okay.
Let's say you have $2 million of losses from real estate. You can only offset $500,000 of the wages. That's it. You don't get to offset all the wages anymore. This is new for 2021. This is actually a big deal that nobody's talking about. Right now, it goes through I think 2026, and this bill and this new bill would make it permanent. Raises about $160 billion over 10 years. So it's actually a pretty big deal, and people aren't paying attention to it. But those of you who are real estate professionals, and one of you has big wage income or interest income or dividend income or capital gain income. Let me give you another example. Let's say that you have a business that's in a C corporation and you sell that business and you sell it for $10 million. Guess what? You can only offset $500,000 of gain with your real estate losses. It's actually a pretty big deal that people aren't paying attention to, and people probably ought to pay a little more attention.
People aren't paying attention to it. To drop back on this net investment income tax of 3.8% that you told us about, it's called an income tax, but is that being applied as an income tax or as a capital gains tax?
It's an income tax. It's just a surtax. So you probably heard that if you make over 10 million, you pay a 5% surtax, right? That's under the new bill. There's a 5% surtax over $10 million. And by the way, that 5% surtax is on capital gains and ordinary income. So it's not just ordinary income. It's on all income. The 3.8%, people refer to it as the Medicare tax, but it's not. It's not going to Medicare. It's going to the general fund. It's just an additional income tax. It's 3.8% on your income in addition to whatever your tax rate is. That means that a lot of business owners that might be in a 37% bracket now are next year going to be in a 40.8% tax bracket. It means that when you sell your real estate, instead of paying just capital gains tax at 20%, you're going to pay capital gains tax at 23.8%.
This hurts both business owners and real estate investors, and kind of this entrepreneurship that makes America great and makes people want to take risks just to put more money into the coffers of a general fund, not even anything specific. I mean, Tom, this feels very much just like a tax the rich theme.
It is. Here's what it is. It's a tax the sort of rich scheme. It's not for the very rich, right? The very rich, they've got their own tax, and there is a tax the very rich. That's the 5%, 3% surtaxes when you get over $10 and $25 million. But the sort of rich, they're the ones who really get hit by this, because this net investment income tax applies for somebody couple that makes over $500,000, which is not rich, as you know. It's sort of rich. It's not really the 0.1 percenters that really get hit hard. The people that really get hit hard are the 1 percenters. The 2 percenters, the 3 percenters, the people who are in that higher than 500,000, but they're not making so much money that they don't need all their money. It's a very interesting, you're absolutely right, a little political commentary here, but I don't think there's any question that this administration is going after small business. I think it's very clear that they have small business in their sights. Let me give you another example. If you are a union business and you make electric cars, then somebody buys a car from you, they get an extra $4,500 tax credit for buying your electric car than if they buy Elon Musk's Tesla that doesn't have union workers.
Wow.
That one, by the way, is going to end up in the Supreme Court, because I can't believe that is constitutional. Because you just can't benefit that we have an equal protection rule in the Constitution of the United States. So I don't think it's constitutional, but they're doing it anyway. And, the idea is that, we want to benefit. Joe Biden has said for many years, I'm a union guy, and he's doing everything he can to protect unions. Well, so who does that hurt? It hurts small business, because small businesses, they can't even afford to be unionized. My dad had a small business. His employees tried to unionize and he broke it. But if he hadn't, he'd have been out of business. He would never have been able to sustain the cost of union workers. And so this is a sustained attack. We saw it first during the pandemic when they shut down the small guys but kept the big guys open. When you keep Walmart open, but you shut down the corner store, that's an assault on small business. And I think this is continuing trend with this administration.
You're an expert at helping people take their tax obligation and make it trend towards zero. So with these new sorts of taxes that are being proposed, and this is very informative, I haven't heard about a bunch of this. Is there any action that one can take to mitigate the effect of these taxes?
Absolutely. Here's the thing, like I said, no politician ever wants to give up power, right? They want more power. So that means that all you have to do is look at, if they're taking some incentives away, where are they giving the incentives? So remember, it's a $1.5 trillion bill, but they're raising $1.5 trillion of taxes, but that's going somewhere. So it's going to increase child tax credits. It's going to automobile makers who have labor unions. Frankly, it's going to, Elon Musk will get his share because it's extending the $7,500 credit for electric vehicles. But let me tell you where it's going from an investor and real estate standpoint. It's going into solar and wind energy. And solar and wind, really, when you think about it, those are sort of energy, but they're really real estate. You need real estate to put your windmill. You need real estate for your solar. Nobody puts,
right.
There are solar farms, which are on land, which is real estate, but a lot of solar panels go on roofs. Solar panels are going to get huge tax benefits. Now, they already do get good tax benefits, but this would extend them, and it would make it 30% credit. So if you're a business owner and you put $100,000 of solar panels on your roof, you get a $30,000 credit and an $85,000 deduction. In a 40% tax bracket, that means you're only paying 36% of the cost of that solar. The government is paying $30,000 in credits and another $34,000 in the tax benefit for the deduction. The benefits for solar are going to be huge, particularly for the business owner. And people who have businesses, they have buildings, maybe even single-family home owners who are renting those out, or multifamily, and they just have to find a way to pass that cost on to the renter, of course. But the benefits for solar, that's where the big tax benefit is going.
This is very emblematic of what I talked about earlier about how so many of the pages of the tax code are really that roadmap for finding the deduction there. So Tom is more than just an alarmist. He makes you aware of what's happening, but he also nearly always has a way in order to offset that or mitigate the effect of that tax on you.
And that's just the way the tax law works. It's a great tool. Politicians love the tax law. They love using the tax law. They love negotiating over the tax law. They love giving favors in the tax law. They love taking favors away in the tax law. Right now, we've got this big fight between the Senate and the House. We'll see if they're still fighting by the time we release this podcast, but they're fighting right now over how big should the state and local tax deduction be. I mean, Keith, come on. You're in a state that has no state and local tax.
Right.
And so basically, any state and local tax deduction at all, you're subsidizing through your federal income tax. And then you're subsidizing California, you're subsidizing New York, New Jersey, all these high tax states. And basically what Trump did in 2017 says, we don't want to subsidize inefficient governments anymore. He just took it out. Now, in fairness to Mr. Trump, whether you love him or hate him, there's pretty much nobody in between. But in fairness to Mr. Trump, that state and local tax deduction has been on the chopping blocks for 40 years. It was on the chopping blocks back when Reagan had his massive tax change when I was back in Washington, D.C. It's just not a new thing. And so now what we have is we have New York, New Jersey Senate congressmen and congresspeople and senators who say, well, we need this state tax deduction and we're going to raise it to $80,000 or we're going to raise it for anybody under $500,000 of income, whatever they're going to do. Whatever the case, it's really a benefit for the rich. And to say that it's anything other than that is a little disingenuous.
You're listening to Get Rich Education. Our guest is Tom Wheelwright. You can learn more about him at wealthability.com. More when we come back, including what's going on with the 1031 and taxation in an era of high inflation. I'm your host, Keith Weinhold. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to 4plexes. They're the number one lender for beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and get your custom plan for expanding your cash-flowing portfolio. Start at ridgelendinggroup.com. You can get a 50-year-old house somewhere or buy a new one directly from the builder with tenant resilient amenities already built in. With over 3,000 Florida units at different construction stages, they are exclusively for investors. President Wagner and Alaska and team also invest strongly in their own product. That's belief. Start at buildtorentdirect.com. That's build the number 2 rentdirect.com or text 407-927-5074.
This is Hal Elrod, author of The Miracle Morning, and listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Wealthability's Tom Wheelwright. He's an expert at helping you reduce your taxes. I've used his referral network for years. He's also the Rich Dad Tax Advisor. He helps you lower your taxes at wealthability.com. Tom, you always stay on top of what's going on in Congress and with forthcoming tax policy. And something that's been, I don't know if it's been as contentious with the 1031 exchange as it has been in these more recent years here, with threats of it being diminished or going away. Now, it seems like previous presidential administrations had threatened removing the 1031 like-kind exchange, also known as the 1031 tax-deferred exchange, which is a huge benefit for real estate investors. So is that being threatened by this administration, or will the 1031 survive?
So for historical accuracy purposes, let's be clear, Mr. Trump eliminated about half the benefits of 1031 exchanges. He eliminated all the tax-free exchanges for anything other than real estate.
Right.
So he took it away from cars when you trade in a car. He took it away from ranchers when they trade cattle. That was all gone in 2017. What they looked at was eliminating the 1031 for real estate. That's done. That is not going to happen. It would be devastating to real estate. It would create a market crash. That's out. The other thing that they were looking at is taxing real estate when somebody dies. And fortunately, that is also out. So the two big things that were against real estate are out. They have not touched bonus depreciation. And the reason for that is it phases out anyway. So there's no revenue there. So we're actually, real estate's outside of that 3.8% net investment income tax. Real estate's pretty much remained unscathed in this new bill.
That is really good to hear. And Tom, this is the first time you've been on the show when we've been in an era of stepped up inflation. And actually part of this has to do with the 1031 exchange. And it's something I've long told my audience. The way I put it is that taxation is not adjusted for inflation. I'll just give you an example. Currently, I'm selling an apartment building. It really hasn't appreciated in value much since I bought it 9 years ago for $850K. Looks like I'm going to sell it for $950K. Well, that's only about a 12% gain over a period of 9 years. So that hasn't even kept up with inflation. So really, that's just a nominal gain. Nominal meaning in name only, not a real gain. But the IRS, of course, they look at that as a $100,000 gain anyway. And if I don't 1031 that ahead, I'm still going to get taxed on that, even though it's not a real gain. So my thought is, with higher inflation, is it even more important to escape taxation legally?
You're right. I mean, inflation does do that. Now, certain parts of the tax law are indexed for inflation. For example, tax brackets are indexed for inflation.
Right.
Nevertheless, you can still get tax bracket creep because the index that the IRS uses may not be real inflation.
Yeah.
It may simply just be the government consumer price index inflation, whatever they decide to use, right? Whatever they're using for indexing that. So you can actually get some bracket creep, but you're right. The real cost of inflation from a tax standpoint is price increases that increase solely because of inflation, not because of an increase in value, but because of a decrease in the value of the dollar. And yet you're paying tax on that, which just exacerbates the inflation, frankly.
Yeah, 100%. Well, Tom, you've been helping our followers reduce their taxes longer than anyone else. If someone wants to learn more about you and get started, or at least have a review of what they got and how you might be able to help them, what's the best way for them to do that?
So I'd suggest two things. First of all, pick up my book, Tax-Free Wealth. If you haven't read it already, that is the book that everybody goes, oh my heavens, it changed the whole way I look at taxes.
Sure. Yeah.
And then, get on wealthability.com. Right on the top, there's a schedule a call. And, we'll get a second opinion. Just get a free second opinion on your taxes. And we'll take a look at it, say, look, there's something you can do, or no, there's nothing you can do. I always say, just like if you go to the doctor and they say, well, you got a problem here, you might want a second opinion. If you're not sure whether you're paying too much tax, get a second opinion, and you can get it for free at wealthability.com.
Tom Wheelwright, you've brought a lot of energy to a super boring topic once again. Thanks so much for helping our listeners. Go ahead and check out wealthability.com. Tom, it's been fun and super informative this time. Thanks so much for coming back onto the show.
Thanks for having me, Keith.
I'd like to welcome in a familiar GRE guest. He's a financial mentor, a best-selling author in the personal finance space. He has rewritten the rules and the plan for retirement. He even founded the martial art of Yokido. He's a really influential guy, and we're welcoming him in for a quick bullet briefing on some big news from the IRA world. Damion, tell us about it.
Hey, Keith, it's good to be here. Thanks for having me back. Can't wait to dive into this.
Yeah.
It's out of nowhere. The McNulty case happened where the IRS went after a couple that had taken their IRA and gone in, used it to buy some gold coins, and they wanted to take control with something called a Checkbook IRA. They came from checkbookira.com. But there's a lot of providers that have created these over the years, especially the last 10. And the IRS said, you know what? This is not how the law was written or intended. You can't take assets and control them and take custody of them. That was the biggest thing. The IRS, the judge said, no, you can't have possession of these things in an IRA and hold them. That's considered a constructive possession event, which means you have a distribution. So they ended up with massive amount of taxes and penalties. And this really disrupted the entire retirement industry, specifically the self-directed portion with the IRAs specifically targeted, because those are always have been meant to have someone outside of the beneficiary being the custodian. Basically, somebody else needs to hold the assets on your behalf. And people have been abusing that. And the IRS finally came in and said, yeah, this isn't going to work. And so they slammed these people tens and tens of thousands of dollars in taxes, and they lost their IRA. It's disqualified. A lot of people are in that similar space. That's the problem. There's also a solution, but that's basically what happened in a heartbeat. Everything changed in the last few weeks.
We're talking about the Checkbook IRA being outlawed.
The Checkbook IRA has been outlawed. You cannot have a Checkbook IRA where you have the ability to write checks and take custody of things. The IRS has said, no, if you have custody of it, that's a distribution to you because there is a custodian involved. A custodian cannot be you. It has to be somebody else. Now, that's only for IRAs, but they've said if you have custody of something, and constructive possession is the legal term that was identified by the courts. And basically, if you've got possession, they're saying, no, you've distributed the assets.
All right, so let's drop back for a moment. Most everyone is familiar with a traditional IRA and a Roth IRA. Some people wonder, well, what is the point of setting up a checkbook IRA or a self-directed IRA anyway?
The idea was to make it more efficient so people could go and they could buy things like gold, silver, private real estate. They could buy into private equity. They could do all sorts of things, and it would make it easier so that you didn't have to go to a custodian every time you wanted to do a transaction. You want to buy something, you could say, okay, I'm just going to write a check. So people were doing that, but the problem is they were taking possession. Who knows what happens after they take possession? Maybe they buy some gold and then they sell it without telling anybody. And so people were abusing this. The difference, traditional IRAs and Roth IRAs, there's always a custodian that held the assets. If you had stocks or mutual funds, right, they were held by whether it was Schwab or Entrust or somebody was holding the assets on your behalf. You could tell them what to do, but then they still held them. And so there was some friction. There were a lot of fees, a lot of delays. And so people said, there's got to be another way. And the IRA custodian said, well, why don't we give people control? They invented this idea of giving people an LLC that allowed them to write checks. It was all well and good, but when people get control like that, there are nefarious characters that will abuse it. And when that happened, the IRS said, no, we're going to make this stop right now.
So this is a brand new ruling cracking down on checkbook IRAs. People were using those because they had this checkbook control, a greater degree of control to write a check and put assets in their IRA that way through writing a check. However, that is the portion, and this is news. This is brand new. This just happened a few weeks ago. This is what is now outlawed. And because this couple, the McNultys, they had a single member LLC that was owned by their self-directed IRA. And what they did was they took physical possession of gold into their own home. And that's what the government, in the form of the IRS commissioner, cracked down on. They said there's no custodian there anymore. So therefore, the McNultys can invade their IRA by effectively cashing out the gold. That's what they cracked down on. So blanketly now all checkbook IRAs and self-directed IRAs are out. Do I have that right, Damion?
All the checkbook ones. So you can still have a self-directed IRA, but you're going to have a custodian involved that's going to take custody and charge you all those fees. And you're not going to be able to hold gold and silver. Again, this is only with IRAs. The checkbook idea of an IRA is what the court said you can't do. And it wasn't just the gold. That was the specific trigger that happened. But they said a checkbook IRA means you have constructive possession. When you have a checkbook with your money in it, you have the ability. There's nobody checking you. And that was the problem the courts had. There's nobody overseeing it. The whole idea with a custodian is they're checking everything to making sure you're in compliance. when people have checkbook controls of their IRAs, there's no custodian compliance because all the custodian does is says, okay, well, you have one asset called the LLC. And at the end of the year, they basically say, okay, tell us what the valuation is for this LLC. And that's it. They file a form with the IRS, and that's not enough. The courts and the IRS said, we need to have better compliance. We need to have the custodians actually doing what they're supposed to do, which means they need to hold the assets.
Okay, so it's the checkbook IRA that did not survive. The self-directed IRA did. Is there any advantage to getting out of the self-directed IRAs that persist?
The big advantage is that the IRAs were targeted. They're a very unique animal under Section 408 of the tax code. The alternative is you can go to Section 401, which is where the eQRP lives. That's where you have the ability to control your assets because you get to be the trustee. So it's a very different thing. A lot of confusion. People get they misunderstand that an IRA is not an eQRP. An eQRP is not an IRA. There's the ability to move almost all IRAs, including checkbook IRAs, over into an eQRP, no tax, no penalty. And at that point, you have the ability, because you are the trustee, to control your assets. And this is well within the code. And it's not something that is even in contention. There's no question that as a trustee, which you get to be the trustee, you have the ability to have a checkbook because it's written into the code that way specifically. If you're the owner of your plan, you get to choose the trustee, and the trustee can be anybody, including you. So this is not gray. This is a black and white code that was written this way. And the cool part is people can fix the problem, the IRA problem. They can still maintain control. They just have to get out of the IRAs. The good news is you actually have control, and you're going to reduce all those nickel and dime fees that go on indefinitely. It's a much better situation for people. It's a much better product. And ultimately, you're not going to be attacked by the IRS like the McNulty's.
So for those that have a checkbook IRA and are looking to get out of it now because they must, or just anyone in general, they might be interested in the eQRP for a few different reasons. I know that the contribution limits are substantially, about 10 times the limit of traditional and Roth IRAs. And then also with the eQRP, you avoid the UBIT.
That's a couple of huge things right there. You can put 10 times more money. The UBIT, a lot of people have their IRAs, these self-directed IRAs, checkbook IRAs. They have them in two things. They have them in gold and silver, and they have them in real estate. And when you have them in gold and silver, well, the IRAs, you can't take possession. With an eQRP, you actually can have possession. So if McNulty's if they'd known about the eQRP, they would not have been in court. They would have been happily looking at their gold of their house. And the other thing is with the real estate that a lot of people are involved with, there's typically debt on the real estate, which is one of the things that we like about real estate. With a checkbook IRA or any IRA that's investing in real estate that has debt, you're going to be triggering that UBIT tax every time there's a sale, which is up to 37% tax. With an eQRP, it's zero because it's exempt. So there's really no comparison. It's like night and day. There's no reason to have a self-directed IRA when you can have an eQRP, and most people can, in fact, have that.
I think more signs are pointing to the eQRP as the answer now than ever. One avoids the UBIT, which is unrelated business income tax with it. They have 10x or so the contribution limits of a traditional or a Roth IRA. And remind us what all you can invest in with the eQRP.
So you can invest in almost anything under the sun other than things that you're going to personally benefit from. So physical gold and silver, private equity, stocks, bonds, debt, if you want to buy and sell notes. You can flip a house inside of this. And this works whether you're by yourself or whether you have employees. If you have a company and you have 50 employees, everybody can do the same thing. So a lot of flexibility. There is only one eQRP in the country. It's the only one of its kind. Nothing else is like it. I always laugh when people say, yeah, we do the same thing. And I'm like, look, just because you have four wheels does not mean you're a Ferrari. It says Ford on your car. That's what you are. You're a Ford. So let's get honest about what it is. And so this really works for you. Anything. I mean, you want to invest in coffee farms in Panama or chocolate in Belize. You want to invest in anything around the world. I mean, probably at some point you'll be able to invest in meteorites with Elon Musk or Peter Diamandis. I mean, it's almost anything you can imagine. And so really, really big differences, especially with the UBIT tax and the physical possession, because as trustee, you can take possession of things and you've got a lot of abilities to do things like converting to Roth. So some people make too much money, and that's one of the problems with IRAs in general. If you make too much money, you can't get money into Roth. eQRPs, there's no limits. You can make as much money as you want, and you still have the ability to get potentially 60,000+ or even more into a plan each year, and it could be Roth. So massive differences, massive opportunities, a lot of flexibility.
That is the legal news that the tax courts brought about. Your checkbook IRAs are no more. Damion, if someone wants to learn more about the eQRP, the Enhanced Qualified Retirement Plan, what is the best way for them to do that?
simply grab your phone, probably what you're listening to this on right now or watching, and text the word eQRP in all caps to 72,000. And you'll get a copy of the report on the eQRP. And you'll also get a chance to get a copy of the eQRP book that I wrote. Have a new copy coming out for 2022. And so really simple, just text the word eQRP to 72,000 and we'll get that out to you.
Damion, this has been a really important update. Thanks so much for coming onto the show.
Thanks for having me. It's good to see you again.
Pretty shocking new tax changes that we learned about from Tom. And then with Damion, checkbook IRAs are newly outlawed. When you, as an investor, permanently reduce your taxes, you can build your wealth faster. And this is more important to people like you that might invest in real estate than an average everyday investor, because for every $1 that you don't lose to taxes, you know how to create leverage with that dollar. And that's both that $1 and your ability to borrow, save for, that we're talking about here. So that's why tax efficiencies are more important to you than someone that doesn't know how to use tools like leverage and arbitrage to create cash flow. What we're talking about here is learning how to escape taxes, not evade taxes. Escaping by using those 5,700 plus pages of the tax code, that is legal. Evasion, that is illegal. So a pretty important distinction there. These two experts really stay on top of this and know their stuff. And I figure if I pay them a few $1,000 for consulting, it's easy to make 10x, or maybe for some, even 50 or 100x. I myself am not a CPA or a tax expert. Again, for Tom at wealthability.com, you can get a free second opinion on your taxes with Damion there at the eQRP company. Right now, you can text eQRP in all capital letters to 72,000 to quickly get what you need as we approach year end. And maybe you can even get that done and out of the way before the holidays. My big holiday to celebrate this time of year is Christmas. I want to wish you a very merry and joyous Christmas if you celebrate too. And for everyone else, a heartfelt happy holidays from me and everyone here at GRE. Operations, Andrea Newbern, Content Manager Matthew Blunt, Sound Engineer Bidner Jumpo, Websites Nikon Roy and Marvin Diaz, Marketing Jake Madoff. I'm your host Keith Weinhold. Happy holidays and don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.